Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial statements meant to be boring with a twist of drama. Get ready because we're about to uncover if Xponential Fitness is truly hitting its stride or just stretching thin. And hey, jump into our Discord community linked in the description below. It is the perfect place to discuss these deep financial dives, so Xponential Fitness Inc. just dropped a Form 8, basically a current report that signals something is up. This isn't your usual quarterly check-in, it is more like a quick bulletin. And what is the headline here? Well, they've got some big new borrowing plans and they're paying off some old debts, all happening on the 8th of December 2025. It is a financial shuffle to say the least, and we're here to decode it. Let's start with the basics. This is a Form 8K a document companies file when they have significant news that investors need to know about right away. Think of it as a public announcement of major events. Xponential Fitness is reporting that on the 8th of December 2025, a bunch of their subsidiaries signed a new credit agreement. This is where they're getting a significant amount of new money. This new credit agreement, dated the 8th of December 2025, is a pretty big deal. The important players here are Xponential Intermediate Holdings, LLC, a part of Xponential Fitness, and Xponential Fitness LLC, which is the actual borrower on the other side. You have HPS Investment Partners LLC acting as the administrator and collateral agent, along with a group of lenders. And how much money are we talking about? Well, the lenders are providing a whopping $525 million in term loans. Plus, there is another $25 million available through revolving commitments. That is a total of $550 million in new financing. Now, that is a serious chunk of change. So, what are they doing with all this cash? A good chunk of it, on that very same closing date, the 8th of December 2025, was used to refinance what they call the closing date refinancing. That usually means paying off old debts. They also used some of this money to repurchase something called preferred stock, which we'll get to, and to cover what they're calling transaction expenses, which are basically fees and costs associated with setting up this whole deal. Now, let's talk about paying this all back, starting in the first quarter of 2026, meaning around the 31st of March 2026, they're going to start repaying the principal on these loans. It is going to be in stages. Initially, they'll pay back a small percentage, about 0.25% of the total loan amount each quarter for the first year. Then, starting in 2027, that payment jumps to 0.75% per quarter, and by March 2028, it'll be 1.25% per quarter. This structure suggests they're expecting the business to generate enough cash flow to handle these increasing payments over time. They also have to make extra payments if they take on more debt or sell off assets, with some standard exceptions, of course. To secure all these loans, the company and its guaranteed subsidiaries are essentially pledging almost all of their assets. This means if they can't make their payments, the lenders have the first claim on pretty much everything the company owns. That is a pretty strong signal about how serious this debt is taken. Here is a really important part for understanding how they'll be managed going forward. The agreement includes a financial covenant. This is like a rule they have to follow. They need to make sure their total net leverage ratio, basically how much debt they have compared to their earnings before interest, taxes, depreciation, and amortization doesn't go above a certain level. This kicks in starting the 31st of March 2026. This covenant is a key indicator of how the business is performing financially. If they breach this ratio, it could trigger a default on the loan. And when does it all need to be paid back? The big term loans are due in 5 years from the closing date, so around December 2030. The revolving part, which is more flexible, also ends in 5 years. This gives them a defined period to manage this new debt structure. Now remember how I said they were refinancing? Well, this report tells us exactly what they were paying off. At the same time they signed the new credit agreement, they also paid off all the outstanding loans from their existing credit agreement that was dated back in April 2021. That amounted to about $369.2 million. And paying off old debt early often comes with penalties. For terminating this old agreement, Xponential Fitness had to pay an exit fee of about $7.2 million and a make-whole premium of around $10.4 million. That is about $17.6 million just to get out of the old deal. Ouch! Let's go back to that preferred stock repurchase we saw mentioned earlier. On that same busy day, the 8th of December 2025, Xponential Fitness also entered into a private deal to buy back some of its preferred stock. Specifically, it is their 6.50% Series A convertible preferred stock and their 6.50% Series A unconvertible preferred street OC. To get these shares back, they paid out approximately $127 million in cash. On top of that, they paid about $1.4 million in dividends that had accumulated but hadn't been paid yet. So the total cash outflow for this repurchase was around $128.4 million. And how many shares did they buy back? They repurchased 114,660 shares of this preferred stock. The big takeaway here is that after this transaction, there are no shares of this preferred stock left outstanding. This is a significant move as it simplifies the company's capital structure and removes a class of ownership that had specific dividend rights. And to get the word out about all these major financial moves, Xponential Fitness issued a press release on the 8th of December 2025. This is often how companies communicate these big events to the public and the market. We're told this press release is attached as an exhibit with this filing, so it is part of the official record. So what is the story here? Xponential Fitness just executed a massive financial restructuring. They've taken on a lot of new debt, $550 million to be exact, to essentially pay off older debts and get rid of all their outstanding preferred stock. This is a bold move. On one hand, it shows they're proactive about managing their capital structure and getting rid of potentially costly preferred stock. The new credit facility might also have more favorable terms, like lower interest rates or more flexible covenants, especially if the company's financial health has improved since the old agreement was made. However, taking on this much new debt also increases their financial risk. They're now on the hook for a large principal repayment schedule, and they've pledged nearly all their assets as collateral. The leverage ratio covenant is going to be crucial to watch. If they can't manage that ratio, it could signal real trouble and potentially lead to default. The repurchase of preferred stock is interesting. It usually signals that management believes common stock is undervalued or that they want to simplify ownership and reduce fixed dividend obligations. The fact that all preferred stock is now gone means that any future growth in earnings will flow more directly to the common shareholders. Overall, this filing paints a picture of a company making significant strategic financial decisions. They're betting on their future ability to generate enough cash to service this new debt and grow the business. The key will be execution. Can they manage the increased debt load, meet those leverage targets, and use the capital effectively to drive profitable growth? It is a high-stakes financial play, and we'll be watching closely to see how it unfolds. Alright, that is our breakdown of Xponential Fitness's latest big financial moves. What is your take on these numbers and what they signal for the company's future? Do you think this debt restructuring is a smart move or a risky gamble? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord in the description below, and as always, thanks for watching. See you next time.